Chapter 4, Sales Practices. 32 questions on the exam coming from the information in Chapter 4. We start with borrowing from and lending to customers. Now, what does FINRA say about this? FINRA says that if the registered representative has a customer and there is a pre-existing business relationship, or if it is a customer and there's a pre-existing personal relationship, borrowing from and lending to would be allowed. We would have to notify our firm, and our firm would have to approve of the lending. What type of business relationship are we talking about here? Well, I'm a registered representative. I have a customer who is in business with me. We have a partnership on the side. We make swings. What about a pre-existing personal relationship? I've got a client who I have known since college. That would be a personal relationship. Borrowing from and lending to these types of customers would be okay with FINRA, again, as long as I notified my firm and got my firm's approval. Now, what about borrowing from and lending to customers who would fall into this group? Spouse, children, grandchildren, parents, grandparents, siblings, brothers, sisters, in-laws, aunts, uncles, nieces, nephews, cousins, people who are financially dependent on the registered rep. FINRA says that borrowing from and lending to these customers would be fine. In fact, FINRA does not require notice, does not require firm approval. Now, I want you to notice that there are 4 of these family members with an asterisk by them: the grandchildren, the grandparents, the aunts and uncles, nieces and nephews, and cousins. It's actually 5. We're going to learn in a few minutes, we're going to learn about Rule 5130, which has to do with an IPO new issue. In that rule, these people are not defined as immediate relatives. They are immediate relatives when it comes to borrowing from and lending to, but not under Rule 5130. So you got to be careful of that. Sharing in a customer's account. Can a registered representative share in an account with a customer? Yes. What does FINRA say about that? Well, number 1, it must be a joint account. The customer's name is on the account. The registered representative's name is on the account. The principal of the firm and the customer must approve of the sharing. Of course, it's got to be in writing. And sharing would be proportional to financial contributions. So I am a registered rep. I have a client. We share an account. It's a joint account. My name's on the account. My client's name is on the account. My principal and customer have approved of the sharing. I put 30% of the money in the account. My client put 70% of the money in the account. How much of the profit or loss could I take out of the account? Well, sharing is proportional to my financial contribution, so I could take out 30% of the money. 30% of the money. Profit or loss. I could take out 30% of the profit. I could use 30% of the loss. Now, please note, this proportional test does not include sharing with family members. So there is no proportional test when we share with family members. My dad is my client. I share an account with my dad. Now, it must be a joint account. My principal approved of the sharing. My customer, my dad approved of the sharing. I put 20% of the money in the account. Dad puts in 80% of the money. How much of the profit or loss could I take out of the account? I could take all of it out. There is no proportional sharing test when sharing with a family member. Investment company and variable annuities. no discounts to non-members. If a broker-dealer is not a member of FINRA, they're not entitled to receive a discount when they buy securities. They would have to pay the same price as the public. Now, in order for a broker-dealer to sell investment company shares or variable annuities to the public, they would have to have a sales agreement with the underwriter. They would promise to maintain the public offering price. In other words, the broker-dealer would give no discounts when they sell investment company products or variable annuities to clients. They would only be purchasing investment company products or variable annuities to fill a customer's order, an existing order. The broker-dealer can never buy investment company shares or an annuity to put into their inventory to mark up and sell at a later date. The broker-dealer shares the load, the sales charge, with the underwriter. So the underwriter gets part of the sales charge, the dealer gets part of the sales charge. The load, the sales charge, is returned to the mutual fund company if the customer redeems their shares within 7 business days of the initial purchase. Now, we talked about that a bit earlier, known as the bad sale rule. Bad sale rule. And finally, the anti-reciprocal rule. The anti-reciprocal rule basically says this: a broker-dealer cannot recommend investment company shares or a variable annuity because they handle the portfolio trades for the investment company or the separate account, and the investment company and the variable annuity, the insurance company, cannot pick the broker-dealer to execute their portfolio trades through because they sold more shares than any other broker-dealer. Continuing commissions. Can a registered representative continue to receive commissions after they leave a firm? Yes, they can, according to FINRA. In order to do this, the registered representative must have a contract with a firm. When would a firm pay continuing commissions to a registered representative after they've left the firm? Typically, this would be in the case of retirement or death. The registered rep has died. Now, in the event of death, then the continuing commissions would be paid to a spouse. Now, these continuing commissions can only be paid on business that was on the books before the event, before retirement or death. In other words, we could not pay continuing commissions on new business. Regulated investment company. A regulated investment company is also known as a subchapter M company. A subchapter M company will use the conduit or pipeline theory when distributing net investment income to shareholders. Now, what does that mean? Use the conduit or pipeline theory. That means that the investment company would distribute at least 90% of the net investment income, NII. Now, how do we calculate net investment income, the NII? Dividends that have been received from stock in the portfolio plus interest received from bonds in the portfolio minus the fund expenses. That's our net investment income. Amounts distributed to the shareholders would be taxable to the shareholders. The amount retained by the company would be taxable to the company. Now, that is a regulated investment company, subchapter M, distributes at least 90%. What if we have an investment company that distributes 80%? Well, it's not a regulated investment company. They're not a subchapter M company. They did not use the conduit or pipeline theory. In this case, the investment company would be taxed on all of the net investment income, that which they distributed and retained. The shareholders would pay tax on the amounts distributed. Now, I say that to folks and they go, well, that's double taxation. Yeah, we're double taxed and triple taxed all the time. Nothing unusual about that. Suitability of recommendations. Now, folks, you're going to see several questions on this test dealing with suitability. Suitability is best learned through practice questions. So I really encourage you to work on the Kaplan's Q-Bank and take a lot of practice questions as it relates to suitability. We're going to cover suitable recommendations here, but to truly understand what the exam is looking for, you need to work on practice questions. So suitable recommendations. Consider for individual clients. What's their financial situation? What's their investment objective? Client looking for growth, they looking for income. What's their risk tolerance? You know, you meet with a client and they tell you that they've lost money in the stock market in the past and they have no tolerance for risk. Well, equities would not be for them. What's the client's tax status? A client in a high tax bracket would be suitable for a municipal bond. Client in a low tax bracket would not. What other investments do they have? Need to complete a client profile. Client profile. Get information relative to the client's situation. What about institutional clients, institutional investors? An institutional investor would be an investor that has at least $50 million invested, at least $50 million in securities. These institutional clients must be able to independently evaluate recommendations that are made. The institution, if they make their own investments, they need to be able to understand their own investment decisions. Now, let's say that you have an institutional client, what you think to be an institutional client, but you learn that they do not have the capacity to independently evaluate recommendations you make. Or they don't have the ability to make their own investment decisions. They rely heavily on you. If either of these two things is not true, then that customer would be treated as the public, Federal Rule 5130. Now, I mentioned 5130 just a short time ago. FINRA 5130 prohibits restricted persons from buying an IPO, initial public offering. Please note that this rule does not apply to subsequent new issues. How many times can a company have an IPO? One time. Let's say the ABC Corporation is going to be selling new shares to the public for the very first time. This would be an IPO. This rule would apply to the transaction, to the sale of those shares in the new issue market. Now, let's say that at some point in the future, maybe 2 or 3 years down the road, ABC decides to sell an additional new shares. This rule would not apply to the subsequent new issue. And the rule basically says if a person is restricted, they cannot buy the shares of an IPO in the primary market. Now, once those shares begin trading in the secondary market, no harm, no foul. Go buy them, go sell them, whatever. But cannot buy in the primary market for an IPO. Restricted persons include a broker-dealer, include broker-dealer personnel, officers, directors, employees, include portfolio managers, include persons who own 10% or more of the broker-dealer's outstanding shares. Restricted persons also include registered representatives and immediate family members of restricted persons, immediate family members of the registered representative or the portfolio manager or the person who owns 10% or the more of the shares. Immediate family members would include spouse, children, parents, siblings, in-laws, would include person who receives financial support from the restricted person. They too would be restricted. I'm a registered representative. I work with a broker-dealer Because of my association, I cannot buy an IPO new issue. Neither could my spouse, neither could my children, neither could my parents, neither could my siblings, brothers and sisters, neither could my in-laws, mother-in-law, father-in-law, brother-in-law, sister-in-law, daughter-in-law, son-in-law. But notice, not restricted. Grandparents are not restricted. They could buy. Grandchildren are not restricted. They could buy. Aunts and uncles are not restricted. They could buy. Nieces and nephews are not restricted. They could buy. Now, that group that I just gave you, those 5, they're not considered to be immediate relatives under Rule 5130, but they were immediate relatives as it relates to borrowing from or lending to. Now, I'm a restricted person. My grandmother lives with me. I provide financial support for her. I pay the mortgage. I pay her medical bills. I pay for her transportation cost. I financially support my grandmother. Is she restricted? Yes, she is. Well, now, Dave, you said that grandparents are not restricted. You're right, I did. She's restricted not because she's my grandmother, but because she receives financial support from me, a restricted person. Therefore, she would also be restricted. How would a firm know if a person is restricted or not? Letter required within 12 months of purchase, attesting client not restricted. So let's say that a client wants to buy an IPO from you, a registered representative. That client would have to have a letter on file attesting to the fact that they're not a restricted person. They're not one of those other people that we just talked about. They're not a registered rep, a spouse of a registered rep, a child of a registered rep. And this letter must be no more than 12 months old from the date of purchase. Now, please be careful. This rule does not apply to associated persons of firms that sell direct participation programs. That's a DPP. That's a limited partnership. Does not apply to associated persons of broker-dealers that sell investment company securities or variable contracts only. So this rule would not apply to us because we work for a firm that offers investment securities, investment company securities and variable contracts only. So this rule would not apply to us. Would not apply to our immediate relatives either. Now, please take note their last bullet point. While we would not be restricted, the broker-dealer that we work with that offers these investment company securities, variable contracts, or DPPs only, would still be restricted. So while the associated person and their immediate relatives would not be restricted, the broker-dealer would be restricted. Now let's look at FINRA Rule 2330. This rule deals with suitability of variable annuities. Rule 2330 says that if we're going to recommend a variable annuity to a client, we must provide to this client certain disclosures. One of the disclosures deals with surrender charges. We've got to let the client know that if they redeem their annuity, if they liquidate their annuity within a certain period of time, that they will have to pay an insurance company penalty known as a surrender charge. And what is that surrender charge? We have to disclose to our client potential tax liabilities. Remember we talked earlier about a variable annuity taking money out during the accumulation phase. If you take money out during the accumulation phase, you've got to pay tax on the earnings. If you take the money out before 59.5, there's also a 10% tax penalty that would have to be paid. And that penalty would be in addition to the insurance company surrender charge. We must disclose to our clients the various fees associated with owning a variable annuity. The mortality and expense fee. Remember the mortality and expense risk that we talked about earlier? Well, insurance company charges a fee to assume those risks. There's also fees associated with the investment advisor managing the portfolio in the separate account. We have to disclose to the client the market risk, disclose to the client the fact that market value could go up, but it could go down, and we could lose value in our annuity. 1035 exchange. Representative must inquire with the client regarding 1035 exchanges within the past 3 years. And they must document this information in writing. So I'm going to recommend a client do a 1035 exchange. Take money out of one annuity and move it into another annuity. I would have to ask the client, have you done a 1035 exchange on this annuity in the past 3 years? And I would have to document the client's answer. Broker-dealers must have in place training as well as supervisory procedures that will explain and teach us about Rule 2330. Prohibited activities. Now, what can we not do? We could not recommend speculative securities to our client unless those speculative securities would be suitable. A client who is in their 30s, they make a lot of money, they want to retire when they turn 50, they're willing to accept a lot of risk in their investments. This would be somebody who would be suitable for a speculative investment. Prohibited, no churning. No churning. This is where we trade for the sole purpose of generating commissions. I got a car note due next week. Somebody's buying something today. I don't care whether it's suitable or not. I need a commission. That's churning. Switching mutual funds from one fund family to another fund family is a no-no. That's a form of churning. Now, in the real world, might there be justification to switch a client from one fund family to another fund family? Maybe, but not on this test. Maybe not on this test. So you have a client who is investing in a mutual fund that's a growth fund. Their investment objectives have changed to income. They need to exchange their growth shares for income shares in the same fund family, not switch to a different fund family. Short-term trading of loaded mutual funds is a no-no. Class A shares, Class B shares. Now, short-term trading of no-load funds, such as a money market fund, is perfectly okay. Recommending a purchase beyond your customer's means, beyond their ability to pay, is a no-no. Fictitious accounts would be a no-no. Now, that's a shocker. That's a shocker. We can't have accounts for clients that don't exist. We continue with prohibited activities. Abusing discretionary authority is a no-no. It's a no-no. One of the biggest challenges with discretionary authority is churning. We saw churning a few moments ago. Discretionary authority is simply an account where the registered rep makes trading decisions independent of the customer. Unauthorized transactions would be a no-no. Would be a no-no. You've got a client. You recommend that they sell their XYZ stock. They say no, they don't want to do that. You think that they're making a mistake, so you go ahead and sell that stock. That's an unauthorized transaction. That violates FINRA's rules and regulations. That's prohibited activity. A breakpoint sale is prohibited. Now, what is a breakpoint sale? This is where we induce a client to buy a mutual fund in an amount just beneath the breakpoint, just beneath the point that the customer would get a reduced sales charge. That's a breakpoint sale. Why would we recommend a client buy a mutual fund just beneath the breakpoint, just beneath the amount that would result in a reduced sales charge? Because we want a higher commission. Breakpoint selling is prohibited. Selling dividends would be prohibited. Now, what's selling dividends? This is when we recommend our client buy a mutual fund just before a dividend is paid, just before a dividend is distributed. The problem with this is just before the dividend is paid, the price of the shares would be inflated by the amount of the dividend. So the customer would pay an inflated price. Now, the customer would receive the dividend, but what would they have to pay on that dividend? Taxes. So that's selling dividends. Better to wait till after the dividend has paid, when the share price would be lower and there would be no tax liability. Unsuitable 1035 exchanges would be a no-no. Excess charges for services would be a no-no. Prohibited activity. Could a broker-dealer charge a customer to hold the customer's stocks and bonds in their account? Could the broker-dealer charge a customer if a customer has their assets on deposit with the broker-dealer? Sure. Could the broker-dealer charge a customer a fee for collecting and distributing dividends? Sure. That's fine. Fee for services, no problem. But these fees cannot be excessive in nature. Folks, Chapter 4, 32 questions on the test.